Welcome to Yahoo Finance Live. It's Tuesday, January 24th. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on that market action that we are looking at with just about an hour to go in the trading day. The Dow moving to the upside, up another 143 points today, adding to yesterday's gains. We're looking at the S&P just barely in positive territory, back above the positive line. They're back up at the flat line, up just about less than 0.1%. NASDAQ Composite, though, that is in the red, off just about 0.1%. Taking a look at the NASDAQ 100, a similar move here to the downside. The Philly Semiconductor Index, one of the biggest outperformers in the market yesterday, giving back some of those gains, off just about 0.8% today. And taking a look at the bond market, you're looking at yield pull back just a bit, with the 10-year yield off just about 6 basis points at 3.46. Digging into some of the sector action that we are seeing, you can see industrials, utilities, the outperformers here, followed by real estate. Coming up in the rear here, the underperformers in the market today: technology just below the flatline, communication services, energy, and healthcare. Let's talk a little bit about technology here. Taking a look at some of the big movers within the NASDAQ. You look at Google off just about 2%. The DOJ suing Google. Well, more on that in just a minute, but that clearly placing some pressure on that stock today. You look at Amazon off just about 0.6%. Taking a look at some of the travel names, UBS was out with a note saying that the recovery may be better than many had feared. And we're seeing some gains here in some of these names. A lot of the cruise lines here moving to the upside. Royal Caribbean, the outperformer there, up just over 1%. Southwest back in the green. You're looking at bookings up just about 0.2%, Dave.
Thank you very much. Google reversing on this news we're about to give you to get you up to speed now on big tech. Google in hot water today over the company's dominance in the digital advertising market. Yahoo Finance's tech editor Dan Howley has the details. Hey, Dan, what are we learning today?
That's right, Dave. The U.S. Department of Justice, as well as a number of state attorneys general, sued Google today, alleging that it takes part in anti-competitive practices with regards to its advertising platforms. Now, they allege that Google essentially owns the entire middle part of the advertising spectrum online. So from the buyers who are looking to purchase ads to the sellers who are looking to sell space on their websites, and that makes it difficult for them to sell and make equitable deals. Attorney General Merrick Garland today said today's complaint alleges that Google used anti-competitive, exclusionary, and unlawful conduct to eliminate or severely diminish any threat to its dominance over digital advertising technologies.
All right, Holly, thanks so much. We want to continue talking about this. The DOJ's latest lawsuit against Google is the Biden administration's biggest antitrust move against big tech yet, and follows from Trump-era action against the group back in 2020. So to put this all into some perspective, let's get to David Balto. He is a former Justice Department antitrust lawyer and former FTC policy director. It's great to have you here. So just first off, your reaction to this case and how strong it potentially could be.
Thanks. I'm concerned about, whether this is really a sound case. The foundation of any antitrust case is the impact on consumers. 60 years ago, Justice Brennan explained that the purpose of the antitrust laws is to protect competition and not competitors. And for the Justice Department to bring a case where it's basically choosing winners or losers or trying to adjust the scales of competition, I think is misguided.
David, does this fit the definition of a monopoly?
It could, but these are markets that evolve so incredibly rapidly. And there's a lot of new entry and a lot of growth in the advertising market. Caution here that Google is, does have a large market share in that market. But is that going to be sufficient? What the Justice Department is going to have to show is that ultimately consumers are harmed by exclusionary conduct by Google that effectively substantially raises prices to consumers. And that part isn't really tied together here in this complaint.
Well, David, within this complaint, the DOJ writing, having inserted itself into all aspects of the digital advertising marketplace, Google has used anti-competitive, exclusionary, unlawful means to eliminate or severely diminish any threat to its dominance over digital advertising technologies. I know you're not sold on this case, but more broadly speaking, the Biden administration cracking down on big tech. What does that signal to some of the other larger competitors here going forward?
Well, I think everybody really needs to bone up on their responsibilities under the antitrust laws, and the Biden administration is clearly taking a more aggressive stance. But to effectuate change, the FTC and the Justice Department have to go to court. And a court is going to ask in the first instance and the last instance, how are consumers harmed by this conduct? And the complaint talks about advertisers and rival web entities being harmed, but it really doesn't say a lot about how consumers ultimately are harmed.
Apparently, a part of the DOJ, the government's case, is something an ad exec inside Google actually referenced, an analogy saying essentially this would be like if Goldman or Citi owned the NYSE, the stock exchange. How fitting is that analogy? And David, what would be a potential remedy if, in fact, the government's right here?
You know, I know as a former prosecutor that you always have these wonderful moments where you find some statement some executive made, and you're going to go and sail forth on that statement, and you'll certainly win in court. And, 99 times out of probably 102, those statements fall short. So it's a nice observation by that fellow, but I don't think it really ties together. Here, there's a natural integration between all the different elements of the advertising business. Those things really do fit in hand in glove. And it's going to be an interesting question about how that integration is harmful. Now, ultimately, the Department of Justice has a very stiff burden in order to demonstrate that divestiture is necessary. Divestiture is really required only in 2 or 3 times in a century. There's just a handful of cases requiring divestiture. And what you've got to be able to demonstrate is that the integration will necessarily lead to anti-competitive conduct, and there's no less restrictive means of addressing the potential for anti-competitive conduct. That's precisely the question the court in Microsoft faced in 2001 when the Justice Department tried to require the split up of Microsoft. And the court said, sorry, you haven't met that burden. And I think the Justice Department will have a really hard time meeting that burden in this case.
David, there's a Reuters piece that mentions that you used to be a consultant for Google. Is that true?
Mm-hmm. Yes.
So what would you be telling Google now today that they are in this position, given the fact that Biden administration once again cracking down and the fact that this is the 5th suit that Google has faced in just the last 2.5 years?
I think I'd advise them to do what they're precisely doing, which is putting consumer welfare at the front of all of their conduct. They are going to compete aggressively because we want firms to compete aggressively. We could go and sort of say, we don't want firms to compete too hard because we want everybody to have an opportunity. But when we try to handcuff competition, ultimately consumers will lose. So I think, I would just always say, put consumers' interests at the forefront and make sure you're satisfying those interests of consumers.
Well, David, this is not all Google faces. They've got a case that starts in September related to 2000 action from the Trump administration over search. They've got 3 other states pursuing action, including Texas AG Ken Paxton. Their lawyers are going to be well paid over the next couple of years. I want to ask you about the story that's coming up next after the break, which is Ticketmaster and Live Nation facing a hearing in front of the Senate Judiciary Committee. You testified against the merger of Ticketmaster and Live Nation. What do you think came out of that hearing today, and might they be broken up? Should they?
Well, here's the critical question. How are consumers affected? And if you've bought a ticket anytime recently, by paying those super competitive charges for access to tickets that there's a monopolist there, and that monopolist is exercising their monopoly power. Quite unlike the situation with Google, there's direct consumer harm. Moreover, there's a very good case for separating the two companies. They're not integrated. there's not efficiencies that come about because the two firms are together. Rather, by bringing the two firms together, they've created a monopoly broth of exclusionary conduct. And the only way to sort of separate that broth is to break up the two companies.
All right, excellent stuff. David Balto, really appreciate you coming on with us today. Thank you, sir. All right, we are just getting started here on Yahoo Finance Live. Still coming up, Live Nation is facing the music. Lawmakers putting the entertainment company in the spotlight on Capitol Hill following the Taylor Swift ticket debacle. Then more pain at the pump. Gas Buddy's Patrick DeHaan tells us what's causing gasoline prices to move higher and how high they'll go. And more tech earnings on deck with Microsoft reporting after the bell today. What does it mean for big tech ahead? Don't go away. Taylor Swift's next album ought to be entitled Fiasco, or perhaps Debacle. Just a few words that describe what happened when millions of Americans were left outraged and without tickets to her upcoming tour when Ticketmaster Live Nation couldn't handle the demand. That fiasco, the subject of a Senate Judiciary Committee hearing this afternoon, something Senator Richard Blumenthal from Connecticut said accomplished the impossible. Listen.
Mr. Berchtold, I want to congratulate and thank you for an absolutely stunning achievement. You have brought together Republicans and Democrats in an absolutely unified cause. And the fact of the matter is that Live Nation, Ticketmaster, is the 800-pound gorilla here.
The 800-pound gorilla that unified Democrats and Republicans. Ain't that poetic from Blumenthal? Ali Canal here with the latest from Capitol Hill. That was a pretty good sizzle there from Blumenthal. What else happened today?
Yeah, and I think the general consensus from both witnesses and senators is that, yes, Ticketmaster Live Nation is a monopoly. It is stifling competition, stifling innovation. We heard directly from Live Nation CFO Joe Berchtold, who did maintain that the Taylor Swift debacle was largely due to increased bot attacks. That excuse was highly criticized throughout the entire hearing. Here's what one witness, Jerry Michelson, CEO and president of JM Productions, had to say in response.
So whether it's said or not, it's implied that if I don't use Ticketmaster, I am not gonna get all the shows that I would like to have.
And he had said that the bot attacks, that doesn't make any sense. If you're a company like Live Nation, like Ticketmaster, that you should be able to handle bots. And just to rewind this here, Live Nation, Ticketmaster, they merged in 2010. Since that time, there have been repeated calls to break them up, since Ticketmaster, in some cases, operates as a 3-business entity in some cases. It is the promoter, the venue operator, the ticketing provider. And as the hearing went on, there did seem to be a lack of clarity and a lack of transparency around certain processes. For example, who sets those service fees? And that's something that's really important for not just competitors to understand, but fans as well. So a developing story. Whether or not this leads to actual change, I don't know, because a breakup of Ticketmaster and Live Nation, that's going to be very, very complicated.
Certainly will be. All right, Ali Canal, thanks so much for that. We want to stick with this, talk about, get a little bit more insight into Live Nation's hearing on the Hill. We want to bring in Douglas Arthur, Huber Research Partners Managing Director. Doug, it's great to see you. So we just heard the latest here from Ali. Live Nation facing accusations of exorbitant fees, which we knew, flawed customer service, anti-competitive practices. What stuck out to you in today's hearing?
Well, I think the Senate hearing, and that was a pretty good summary of the big points there, but it kind of told us everything we already know, which is that Live Nation dominates ticketing, they dominate venues, and they dominate the artists. And according to the Justice Department, they occasionally, take advantage of that and use their muscle to get artists into venues or not into venues that are not using all 3 of their services. So I thought it was a good kind of layout of the issues. The question, as your spokesperson said, is what do you do about it? And the Senate kind of acknowledged that they can only present the facts of the industry dynamics and what's broken. It's up to the DOJ to do something about it. And obviously, Live Nation's operating under an extended consent decree, which the DOJ is overseeing. So everybody knows the facts. The question is, what do you do about it?
Yeah, I mean, Live Nation, Ticketmaster controls 70% of the primary ticketing and live event venue market, which is astounding. I know you're not an attorney, but your guess is, do you think the government will act here?
I think, listen, when you rise to the level of a Senate hearing, and those are pretty, senior senators, there's heat. And whether the DOJ responds to that or not, there will be heat to do so. So, look, I think it's highly unlikely that Ticketmaster is divested from Live Nation. Live Nation would be a shell of itself without Ticketmaster, in my view, because that's where they get all the data on consumers that powers the rest of their business. And the point I thought was interestingly made, that the concert business, which is a 1% margin business, maybe a little higher recently, is a loss leader, and that Live Nation, gets the acts to sell the ticketing and the sponsorship and advertising. That's where they make their money. Without Ticketmaster in the center of that cog or that machine, the parts wouldn't hold together as well.
So, Doug, what does this mean then from an investor perspective? You're an analyst covering the stock. Taking a look at shares, at least today, they're still moving to the upside despite all of these concerns.
Listen, it's an interesting situation from an investment point of view. Obviously, the stock is down from 125, got down to, it's below 70 recently. you have to look at the Live Nation outlook going into 2023, and you look at who's announced they're going out on the road, whether it's Taylor Swift or Bruce Springsteen. I mean, there is a tsunami of big acts that want to get in on this reopening surge. So what we saw in 2022 was record profits at Live Nation. I think we're going to see that again in 2023. Not a lot of companies, looking at the vagaries of the economy right now, you can say that about. They did have to lever up a lot to survive the lockdown. They doubled their debt. So I think my underweight is somewhat of a valuation story, but you have to acknowledge the underlying numbers are very strong.
Doug, you point out this is a 12-month period in which Americans, largely speaking, shifted their spending from goods to services and experience like concerts. They were eager to get out there. You just mentioned the incredible lineup. Why are shares down 29% over the last 12 months?
Well, number one, I think it's valuation, and they're heavily indebted, which they just did something about with $1 billion convertible equity offering, convertible bond into equity. I think the uncertainty over the future of Ticketmaster, which kind of led up to this hearing, is another overhang on the stock. And it's probably a buy on the news event where there was worry going into the hearing. The hearing's over. I think people kind of walked away and said, gee, good explanation of the issues, no immediate solution. Maybe the DOJ will do something, maybe it won't. Life probably goes on here. And so there's a relief rally in the name.
Certainly seems to be the case, at least today. Douglas Arthur, great to have you. Thanks so much for joining us. Well, coming up, early morning chaos. Trading was halted for several companies on the New York Stock Exchange after wild price action at the start of today's session. We'll tell you why next.
Quote, "We haven't seen this in years." Traders and market watchers reacted in open-jawed shock at this morning's market moves. The New York Stock Exchange apparently suffering a, quote, glitch.
I know, it was pretty incredible. It took me by surprise. Jared Blickery has been all over it for us today. Jared, what happened and what does this mean, do you think, going forward?
Going forward, I don't think we have a lot to worry about. Probably a one-off here, but we should review. This affected 252 names. This is only about a third to a quarter of them. And at the opening auction, and that's basically the opening bell here, you have trades that are supposed to be matched, and that did not occur. And so you had all this liquidity. If you can think of the bids up here and the offers down here, all that vanished, so that by the time the exchanges got some information from the New York Stock Exchange, it was too late. A bunch of trades had executed way above and way below the prices. So in a bunch of these big names like Walmart, Taiwan Semi, ExxonMobil, a lot of those trades are going to be canceled. And we just found that out a few minutes ago when we got this notice from the New York Stock Exchange. Not going to go into all the details, but basically any stock or any security that was subject to these trades early on today, if they were out of those volatility bands, probably going to be decayed or just overturned. This is a fact of life. It happens. They weren't supposed to happen in the first place. Perfectly legal. Sometimes erroneous trade happens, and now they're going to be canceled. But if you think you were affected, make sure you check your account statements. You're going to have only a few days to probably review, and if there are any problems, correct the situation.
All right, Jared, thanks so much for that. So we had a major technical glitch at the NYSE, a mixed Fed in a blackout period, and a laundry list of S&P 500 companies reporting. Not much to discuss here, right? We want to bring in Charles Schwab, Chief Global Investment Strategist, Jeffrey Kleintop. Jeffrey, we certainly have had no shortage of headlines here coming out today and over the last several days. I'll let you take your pick just in terms of what you're focusing on and your huge takeaway from the trading action so far this week.
Well, I think one of the things that's supporting the markets here is that China's reopening. I mean, this reopening has led to better PMI numbers we got this morning in Europe. Europe is one of the biggest suppliers to China. They're seeing that return of demand really helping to boost activity there. Their PMI numbers coming in above 50 for the first time in 6 months. So their economy back in expansion territory. You're seeing that show up in some of the earnings forecasts as well. I would look to some of these businesses that have a lot of China exposure to perform relatively well as we go through the earnings season, as they guide up, perhaps relative to what they were thinking even just a few months ago. I'd note that there are some big tech names reporting this week, like Intel, with 25% of its revenues tied to China. So there could be a big story there, all tied to what's going on over there in Asia.
And we'll get Microsoft in just a bit, but we also heard from 3M, from Union Pacific, from Verizon. You mentioned the tailwind of China reopening, but a lot of headwinds in those earnings. Nothing great about what's around the corner in this economy, and yet you look down at the S&P and it's essentially flat on the day. What does that tell you? What did you learn from those relative bellwethers on the economy?
Well, clearly we are. I think it's pretty clear we're in a recession. I know official recession hasn't been declared yet, but I think it's fairly obvious we're in a pretty mild one here, maybe in Europe as well, other parts of the world. And so we're seeing pretty lackluster revenue growth, and that's leading us into an earnings recession. But it's a fairly mild one. If you take a look at what businesses are talking about, we're looking at mild year-over-year declines, maybe this quarter, maybe next quarter, maybe in the second quarter as well. Nothing like the 20 to 30% earnings plunges we've seen during prior recessions. So this is a fairly mild one. And I think the market's looking for signs it's nearing an end. We're not there yet, but I think that's one of the things lending some support to equities despite somewhat disappointing results.
Jeffrey, what are some of the signs that you're in particular looking for in terms of determining whether or not we are near end of that recession?
Well, a couple of things. One, are we close to the end of Fed rate hikes? One of the things we can watch tomorrow is the Bank of Canada. The Bank of Canada has been one step ahead of the Fed every single meeting this year. They were one meeting ahead of the Fed to hike rates, one meeting ahead to begin to step down. And now they're signaling tomorrow maybe their last rate hike. And if that's true, confirmed with the press conference, what we hear from them, that could be a sign that maybe the market's willing to extend the same kind of invitation to the Fed to say, hey, it's time to take a pause. And if that were true, certainly we ought to see stocks react positively. But if the Bank of Canada finds other reasons to be concerned about inflation, perhaps because of the revival in China's growth picture and the potential inflationary consequences of commodity demand return returning, goods demand returning. I'd note we heard from a few businesses that their inventories have come down fairly rapidly, in part because of Chinese consumer demand. That maybe give them back some pricing power in categories that had been falling, like furniture and apparel. So we'll have to see what that means going forward. But certainly, central banks are going to play a key role this week and next.
Yeah, that sounds disinflationary. I mean, that sounds like the Fed, they don't want to see that. But your notes point out that international stocks have been outperforming. Why, and do you expect that to continue?
Yeah, this happens every recession. We see a reversal in the performance of U.S. and international stocks. So whatever performed last cycle then goes and underperforms in the next one. It's behavioral as much as fundamental that we see this happen. After a full cycle of outperformance, trends revert. It was in the 1980s and the 2000s that we saw international outperform, and then in the 1990s and the 2010s, U.S. stocks outperform. Now we're seeing that rotation begin to favor international stocks, and for a variety of reasons. One, valuations are lower. Two, earnings are coming in stronger. But we're also seeing a lot more of the characteristics that have led to outperformance here over the past year, like low price to cash flow ratios or high dividend yields. Really, the market's favoring those characteristics, and they're found more prevalently outside the U.S. So last year, we saw international stocks outperform for the first time in a decade. This year, we're also seeing that leadership. I think this is a longer-term trend, and so something that many investors are probably not aware of, or even the risk in their portfolio of not owning some international diversification, simply focusing on U.S. equities. So I'd keep that in mind as you build your portfolio here. Look just beyond the U.S. now.
And Jeffrey, speaking of that, from an investor's perspective, if you're looking to capitalize on that, I know you specifically like China, but what are some of the ways that you are playing this recovery that you're seeing overseas?
You know, the beauty is you don't have to be country specific right now. There are times when you want to be very specific in your sectors, your industries, and your countries. I don't think you need to be now. Broad international exposure through, one of the major ETFs or funds or other solutions that provide exposure around the world. Europe looks particularly good right now. The economic surprise index in Europe is nearly hitting 100, meaning economic data is coming in so much better than economists expected. And we're seeing a better outlook there transferring maybe in earnings as well. But in Asia, with China's reopening, that's beginning to fare better. With the commodity demand picking back up, Latin America is improving. So there's really a lot of areas around the world that are working right now, leading to outperformance of the U.S. market. So I don't think you need to be very specific. Broad diversification can pay off here.
All right, Jeffrey Kleintop, good stuff. Thanks again, my friend. Coming up on the show, show me the money. Walmart, the country's biggest private employer, is boosting paychecks by how much? The good news next.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. On deck, we have Lyft, Lululemon, and Walmart. My pick today is Lyft. Shares climbing after KeyBank upgraded the stock. You can see it now up just about 0.3%. They upgraded the stock to overweight, setting its price target at $24 a share. Analyst Justin Patterson arguing that the company has turned a corner, and that's being helped by, quote, aggressive cost-cutting measures. He sees a, quote, meaningful opportunity for EBITDA to improve in 2023 this year. Lyft shares off to a very solid start since January 1st. You're looking at significant gains at more than 40% this month alone, but that's after sinking more than 70% last year. Josh, we know their rival Uber have I guess, really expanded their business, have a massive advantage. The huge argument on the street is over Lyft right now. So Lyft might be able to claw back some of that business following that 70% drop. But I think there's still a lot of questions just in terms of how well or how much they are going to be able to grow that market share over the coming months.
We've certainly seen Lyft more focused in the traditional rideshare business, right? Rather than, say, Uber Eats or all the different places Uber's expanding. But I think another interesting thing to point out here, Shauna, is when you think about the layoffs. 2 months ago, you had Lyft, not Uber, laying off about 13% of employees. Now analysts are starting to talk about, well, the cost cutting's working, wondering how often we're going to start hearing that from these tech analysts when we think about all these layoffs we've been reporting on the last couple of weeks. In a couple months, where do people start liking the cost cutting, and where did that maybe work or has not worked? Will be interesting to watch for sure. But my play today is Lululemon. Shares falling today as Bernstein says it's, quote, time for a reality check for shares of the popular athleisure brand. The firm downgrading the stock to underperform and slapping a $290 price target on the name. Now, analyst Anisha Sherman noting the company's push to digital, the rise of athleisure, and return to office attire all helped Lulu achieve a 25% compound annual growth rate over the last 5 years. Shares rose nearly 300% in that time period, Dave. But expectations are simply too high from that. We've already seen some of this recently. Remember, investors weren't impressed with Lulu's guidance last quarter in December, and the company is already guiding for a yearly decrease in gross margins for the upcoming fourth quarter release. Now, Bernstein argues the next area where we could see growth just aren't big enough. We've talked a lot about Mirror. Is that going to work out? They call that disappointing.
It's not.
They pointed out that footwear is less than 5% of revenue. Interesting to highlight where they think the growth could come. So we know Lulu as the direct-to-consumer company. What if Lulu went wholesale? It would change the whole brand, obviously, open up a different part, but basically insinuating Lulu is going to need to completely change if they want over 20% compound annual growth to continue.
Change your entire market too, really. That changes the perception of the company.
Right. Are you still a premium brand if you go to wholesale?
And look, no is the answer. And boy, how this story has changed, because Jefferies also has a sell on the stock and a $200 price target, showing a massive downside from the 310 today. And I love what they say, the death of the belt bag, they call for it. That peak has peaked. I was in the store the other day, and all the salespeople were wearing them around their shoulder. And I asked them, are you a little bit tired of wearing that? And they kind of winked, yes. They were tired of pushing it. So
convenient.
It looked a bit obnoxious on the guys, I quite frankly thought.
I love it.
I'm sure you do, but these guys looked miserable wearing their belt bags.
I guess if you had to wear it 12 hours a day or however long they're working at Lululemon, I could see how they
I just got my mom one for Christmas and told her it made her hip. So I guess I'm behind, Dave.
Yeah, just
you should have done it last
Not up with the
year.
trends. Yeah, exactly, right?
I'm with Jefferies on this one. All right, my play is Walmart. WMT, a trending ticker on Yahoo Finance today. The largest employer in the U.S. announcing today it's increasing starting pay from $12 to $14 an hour. The retailer says more than 300,000 U.S. workers will see a raise in their March paycheck. Walmart says hourly workers currently earn an average of around $17 an hour. Rivals Target and Amazon have a $15 an hour minimum wage. The unemployment rate, though, it's still near a 50-year low of 3.5%. The Fed currently estimates it will increase to 4.6% in 2023. Now, Walmart shares mostly flat today. Didn't really move on this news. Mostly flat this year and up less than 2% over the last 12 months. I talk about that unemployment rate, 50-year low, Shauna, because This is another one of those stories, like the stories we mentioned earlier in the show, might not be what the Fed wants to see as wages continue to increase, as they'd like to see them come down.
Yeah, certainly, because that adds obviously to the inflationary pressure, something that the Fed has been trying to get under control now for some time. But obviously for Americans, this is huge. This is amazing. This is obviously way overdue when you take into account how much more people are paying this year because of inflation. How many states have not raised their minimum wages yet? So another company here stepping up and raising the wage once again. Obviously very good. You mentioned, though, that it's still below some of its competitors, which was stuck out to me because the fact that job openings still so high, millions and millions of job openings here in the U.S., so many companies like Walmart having a very tough time recruiting the workers, getting the workers they need through their doors. I would have thought that maybe they would have raised it to $15 an hour.
I was going to say $1 below Amazon. You would think right there you just match them simply just to on your surface say that you pay just as much as Amazon, right? It's only $1. I don't think that's going to cost them that much. It probably would have been a better look.
Yeah, certainly. But again, an important story here to keep in mind. Well, coming up next, the crude reality is you're probably paying a little bit more at the pump again. But who can we blame this time? We'll talk to the head of petroleum analysis at Gas Buddy on the other side of the break.
Gas prices climbing for the fourth straight week, up around 35 cents in the month prior, according to national averages from AAA. Crude oil pulling back slightly today after recent gains. Our next guest can explain what is weighing on oil and where prices might go in the coming weeks and months. Patrick DeHaan, Gas Buddy's head of petroleum analysis, with us now. Good to see you, Patrick. So why is gas rising back again so quickly? How high do you think it'll go?
Well, a lot of this really starts back in mid-December with that Arctic blast, which shut down refineries due to extremely cold weather. Many of those refineries, of course, exposed to the elements, and extremely cold temperatures can lead to equipment malfunctions, pushing off millions of barrels a day in production. And then shortly thereafter, China announced its reopening, something you were talking about in the previous segment, something that also has a major influence on the price and consumption of crude oil. That's pushed oil back close to $80 a barrel. In addition, we have the end of the release from the SPR. No oil was released last week. In addition, new sanctions on Russia by the EU causing some level of nervousness as well. So All of that has pushed up gas prices, a trend that could continue in the weeks ahead as refineries are on the cusp of starting maintenance season, and then the transition to summer gasoline just around the corner.
So, Patrick, then how high are prices headed? We're at $3.45 today. You're saying the trend's to the upside, back above $4?
I certainly think that is where we'll head. It's a question of when, not if. I think something like that could happen by potentially April, maybe sooner. We have a pretty heavy amount of refinery turnarounds that are going to start here in the next couple of weeks, and that's going to lead to a diminished amount of gasoline supply at the same time that pipelines are starting to roll over to that summer spec of gasoline. So I think motorists are going to start getting squeezed more so starting in late February. The next 3 weeks could be a bit of a mixed bag.
Politics, like everything, comes into play here as the White House press secretary, Patrick, said House Republicans will vote to raise gas prices on American families. Is there any truth to that? And has the Biden administration put this country in good position as we begin 23?
Well, if you're a motorist, this would be like putting on sunblock to block the harmful rays of the sun. I think politics is the same thing. And too bad there's no lotion that you can put on to have all of that bad information bounce off of you. But, you know, a lot of this political on both sides of the spectrum, finger pointing isn't going to slow down. But at the end of the day, it has everything to do with supply and demand. And it really doesn't matter who's in the White House or who has power. Supply and demand is really the ultra power in control of the market. And, you know, with China reopening, you can't underscore enough. The U.S. economy, when we reopened, saw a level of pent-up demand. I would expect that once China gets over the hump of initial surge in COVID cases, that the same would apply in China. And that is likely to chart our course for the next 3 to 6 weeks as China gets underway.
Patrick, what about diesel? Because today's average $4.63, we're looking at a month ago, was actually higher at $4.69. The big driver there, and I guess why are we seeing the opposite take effect in diesel when you compare it to what's happening in regular gasoline?
Well, gasoline has come down a lot quicker than diesel. Diesel has really rebounded. I should say supply of diesel has continued to rebound in the last few weeks, and that's given stations more of a margin on falling prices. So that's kind of delayed diesel's increase, but that has now happened. Diesel prices picking up about 2 cents a gallon in the last week. All of the story with diesel really has to do with a recovery in diesel supplies, as we've seen certainly a bout of warm weather the last few weeks, diminishing the consumption of heating oil in areas of the Northeast. But now diesel prices may inch up, but keep in mind, as we start to see warmer weather, as we get closer to spring, it's really going to be two questions. The warmer weather, how will that impact demand here? And what's going to happen not only in China, but the global economy? Keep in mind, diesel prices have far more exposure to what's going on in Europe. Europe continues to import diesel. And now with those February 5th sanctions that are going to be on refined products from Russia, diesel prices could be in the spotlight again here soon.
Yeah, you're talking about that weather, still waiting for the first flakes of snow in New York City, approaching a record. Quickly, natural gas has plummeted more than 50% in the past month. Will that continue? What are the implications?
Well, you know, certainly compared to starting the winter, natural gas is very tight. Europe inventories were looking challenged. And now, you know, Freeport coming back online, there could be a level of recovery once FERC reapproves Freeport reopening their facility. But for now, you know, thanks to that warm weather, thanks to the fact that New York hasn't seen a flurry fly, or at least 1/10 of an inch, I think is the measurement. That's part of the reason why natural gas prices have been suppressed this winter, is because of warm weather here and in Europe, leading to above average supply.
Gas Buddies, Patrick DeHaan, always a pleasure, sir. Thank you. Coming up, collateral damage. Binance admitting an error with user funds today. It's another bad look for the major crypto players. We'll tell you what the mistake was and why it matters. Next.
crypto platform Binance acknowledging a storage mistake that found some of its collateral coins mixed in with customer funds. Yahoo Finance reporter David Hollerith is here with more on this. David, obviously something that investors clearly don't want to hear. What happened?
Yeah, since FTX collapsed, a legitimate fear, probably one of the biggest fears for crypto investors, that the money they're keeping with an exchange is being used for something they didn't intend for it. So today, Binance admitted this mistake where they mix collateral for their own tokens that they issue with customer funds. So effectively, they put collateral for tokens into a wallet meant for customer funds. And that doesn't mean necessarily they did anything specifically with customer funds they were not supposed to. Binance has repeatedly stated and continues to do so that they back customer funds one for one. But obviously, commingling of these two different kinds of sources of funds is not a good practice. And effectively, it enables the kind of thing that allowed FTX to allegedly spend billions of dollars in customer funds on things like political donations, Bahamas real estate, and risky crypto trades for their hedge fund Alameda Research. So evidence of this was traced using blockchain data. Several analytics companies were on this, and it was first reported by Bloomberg. And Binance has since said that it's addressing the issue and that over the coming weeks and months, customers will see updated crypto wallet addresses for this collateral, meaning it will not be in the same crypto wallet as it keeps customer funds. But FTX has obviously sparked an increased scrutiny on how exchanges are keeping their funds. Binance has taken a lot of heat since then. It published a proof of reserves report, which was meant to show its asset balances to sort of shore up confidence to customers. But the report only showed its Bitcoin holdings. And that sort of just sparked widespread scrutiny because a lot of people were asking, why couldn't Binance show any of its other assets? And obviously this report fell short of, it felt very short of any kind of full audit. So, they're still sort of on the ropes in terms of offering the transparency that widely investors are seeking.
All right, David, more from the not great news file. A Reuters report found that Binance did business with Bitslato, that's a small crypto exchange, involved in a big money laundering lawsuit. What do you know?
Yeah, so the Justice Department charged Bitslato last week. And specifically, they charged the executive of Bitslato, who was in Miami, Florida. And Bitslato is said allegedly facilitated the flow of more than $700 million in illicit crypto. And as part of that initial complaint, the DOJ also named Binance as one of its three major trading counterparties. Now, blockchain data from Chainalysis, seen by Reuters today, revealed that Binance moved a total of $346 million in Bitcoin for Bitslato between May 2018 and last week. And the thing to note here is that Binance is the world's largest crypto exchange. It doesn't operate in the U.S., but smaller exchanges do use it to facilitate trades. But obviously, this is an oversight on their part. And it might beg the question about whether or not U.S. or other authorities will be putting on more penalties to the exchange.
All right, David Haller, thanks so much for the latest on that. Well, coming up, mixed markets here for just about, 5 minutes to go till the closing bell. Dow holding on to gains up just about 100 points. S&P, NASDAQ in the red. You're looking at losses for the NASDAQ off about 0.3%. We'll be right back.
All right, we're just now a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the market action post-glitch.
Post-glitch, hopefully everything works out in the close, guys. We'll talk about that in a second, but the Dow up about 0.33%, NASDAQ down 0.25%, S&P 500 right in the middle, just down slightly, Russell 2000 off about 14 basis points. Not a whole lot of action today in the indices, but we got some stuff going on underneath the surface. So we got split here. We got industrials, utilities, real estate, staples, financials, materials, all of those outperforming most of the cyclical sectors up there, or some of the cyclical sectors, but also some of the defensive ones. So pretty interesting. Real estate, staples, utilities, those are the defensive ones. To the downside, healthcare, communication services, and energy. Those are the biggest losers. And just checking on our leaders here, we have ITA. I haven't seen transports lead in a while. That's up 1.5%. Bets, that's the gambling ETF. That's getting some love here. But for the most part, you're going to see more losers than winners here. ARK Invest, that's down 1.5%. And let's just take a look at ARK here. Just about everything in the red. Not a whole lot of dark red today, so I am paying attention to where we're seeing this. Shopify, Coinbase, Roku, actually PagerDuty. Those are some of the names and a lot of those software names that are down today. Want to focus on Tesla here because we got earnings after the bell tomorrow. Today is Microsoft, tomorrow's Tesla, and we're going to be keeping that, watching that here for you and breaking that news. Tesla's up 16% year to date, but let's take a look over the last 2 years so we can see what's going on here. Now, we all know this. The top here was October of a couple years ago, and we are down considerably, sold off about 60% from those highs, still down about 50%, even though we are off considerably from those lows. Now, tomorrow, the options market is implying a move of about 10.7%. So you take the current price right here, 143, multiply it by 10%, so that's about $14. You add that to that, subtract it, you got a nice collar for what traders are expecting the move to be. So keep that in mind as we head into the bell and after the bell tomorrow. But in the meantime, let me just round out the conversation here with a look at some of our leaders and laggards in the NASDAQ 100. Apple in the upper left, that's up 1%. Alphabet down 2%. I mentioned communication services as one of the sectors getting a little bit of a hit today. Pinduoduo up 1%. Netflix up 2%. Really not seeing a whole lot of rhyme or reasons to a lot of these names here. Let me just circle back one more time on some of these stocks that were affected by that opening glitch. If you got a trade that was either too good to be true or too bad to be true this morning, probably going to be canceled. So anybody who sees something puzzling on their brokerage statements over the next few days or doesn't think they got the cancellation they deserve, well, take it up with your broker here. All right, a couple seconds to the closing bell, so I'm just going to send it off that way. Here's a closing bell on Wall Street.
All right, that does it for today's trading day. Dow, the only major average, holding on to gains, closing up just over 100 points as we shake out the final trades of the day. S&P and NASDAQ, though, to the downside today. The NASDAQ, the underperformer there, off just about 0.3%. Taking a look at the sector action, what Jared was just mentioning, a bit of a mixed picture here. Healthcare, the worst performer, off nearly 1% today. Energy not too far behind, followed by communication services and technology. On the flip side, bucking that downward trend, utilities, one of the outperformers today, as well as industrials. Industrials closing up just about 0.5%. Let's take a look at some of the top movers of the day. First up, speaking of industrials, let's talk about 3M falling today after an earnings miss. You can look at the stock closing off just about 6%. Now the company signaling more turmoil to come this year in 2023. 3M also announcing that it plans to cut 2,500 manufacturing jobs. Layoffs spreading from the tech sector here, Dave, to other industries. We're certainly seeing that reflected more broadly across a number of industries as we brace for more of these types of announcements. We're only, 2.5 weeks into this earnings season. The majority of those layoffs have been concentrated in technology, but 3M certainly bracing for what will likely be a challenging couple of quarters. They're looking to cut costs, and they're doing it by eliminating some of their headcount.
Yeah, this is an employer of 100,000 employees, so we are starting to get a glimpse of what could potentially be around the corner as you see layoffs spread and you see predictions for the economy really beginning to soften. They really cites several times slowing demand, and that's at the heart of it. I want to highlight something CEO Mike Roman had to say in the earnings call. The slower than expected growth was due to rapid declines in consumer-facing markets, such as consumer electronics and retail, a dynamic that accelerated in December as consumers sharply cut discretionary spending and retailers adjusted inventory levels. We also saw a significant slowing in China due to COVID-related disruptions. So yes, on the tail end, you do have some good news coming around the corner as China begins to reopen. But look, ultimately, the big picture takeaway is that slowing demand, consumer-facing side of 3M shows what we're going to be enduring in the first half of 2023, a slowing economy, whether we like it or not.
Yeah, certainly it is a slowing economy. We know that when you take a look at 3M, oftentimes it's a bellwether for this sector, which is why we're placing so much emphasis on this report, because it could signal some of those weakening conditions more broadly for the industrial sector. When you take a look at some of their numbers, their outlook there, that disappointed. 3M expecting sales to decline 2 to 6%. Now, in terms of what the company will do going forward, they do have the capacity for deals, but they likely will be conservative in this environment, in the economy, which is clearly very challenging right now. In terms of the street's reaction to this report, Vital Knowledge was out saying that there's nothing positive in this report, in this guide, other than, quote, expectations were already very low. Most of the weakness seems to be confined to that consumer business that you were just talking about. So I guess if we're looking for a positive spin on this, yes, the consumer side of their business obviously very weak right now, not necessarily the case for 3M at large.
Looking pretty hard for some positive news. Revenue growth of 0.4% on 1 to 3% expectations. While 3M is cutting staffers, other sectors are still struggling to find workers. Union Pacific CEO Lance Fritz spoke with Yahoo Finance following his company's earnings report earlier today and discussed the state of employment at Union Pacific. You can see shares falling more than 3% on their earnings report. Here is their CEO earlier today.
The hiring picture was very difficult through last year, and specifically in areas where we operate in a rural environment where the workforce is small and the unemployment rate are very low. That's areas like in the middle of Iowa, in the middle and western Nebraska, out into Wyoming, and even up into Minnesota. Now we're doing things like paying a $25,000 hiring bonus in certain spots. We're adjusting other aspects of the job. We've made sure our training produces a conductor that's fully capable and ready to work.
Boy, that's a telling statement right there, Sean. And I think we're going to see this on so many different sectors of the economy. Difficult to find employees right now. You know about the labor negotiations in rail and with port workers. You can touch on just about every type of job that falls in line with this. Truck drivers, mechanics, the nurses. There is a shortage of employees, and how you're going to incentivize employees throughout this year is going to be an impossible task if they're offering $25,000 bonuses and still not finding enough employees in this economy.
Yeah, they aren't finding enough employees in this economy. The word hiring was mentioned 10 times in that earnings call. It really just speaks to the challenge that this presents for Union Pacific here going forward. They have, though, been adding to their headcount, obviously not as quickly as they would like. Their headcount is up 4% at just above 31,100. They do have 600 additional workers currently in that training program that Lance Fritz was just talking about. But on this earnings call, when we talk about the impact that it's having on their business, the company's saying that they still have tight spots in the network that are limiting their ability to grow and to ship all of that demand because they simply do not have the workers to meet the demand that their business is facing right now. And not only that, they're also facing higher costs. Another challenge, another headwind here for Union Pacific going forward. The cost per employee, talking about some of those incentives there, that grew 6%. That was primarily driven by wage inflation. They need to pay workers more in order to keep the workers that they already have. Also higher fuel costs, clearly a headwind here for the company. Fuel costs were up about 43%, which has clearly hurt their bottom line. We're looking at shares off just about 3%. Also want to quickly take a look at Verizon, also out with earnings today, boasting an increased subscriber base and boosted revenue, but guidance for the 2023 fiscal year came in lower than what the street was expecting. Verizon guiding for earnings per share in the range of $4.50 to $4.85. The street have been looking for $4.96 there, so below what the street was looking for, yet shares moving to the upside today. I think that subscriber number better than expected. 217,000 new wireless subscribers were added during the fourth quarter. That beat the street's estimates, but clearly when you stack that against some of its competitors out there, T-Mobile and their prelim number adds, Dave, they said that they added over 900,000. AT&T expected to add over 600,000. So you can clearly see Verizon there losing some of its market share to its biggest competitors.
The CEO saying current levels of sales and discounts being offered across the industry unsustainable, adding that 5G story really has not come to fruition, and they would like investors them to cut spending there. Let's shift now to the big report of the day we've been waiting on. It is in. Microsoft just out with their latest earnings report, and you can see shares up more than 4.5%. After hours, Yahoo Finance tech editor Dan Howley has the numbers for us. Dan, what stands out to you?
That's right. Microsoft missed slightly on the top line, but beat on earnings per share. Revenue came in at $52.7 billion. Expectations were for $52.9 billion. So you see that little miss there. But adjusted EPS came in at $2.32 a share. That's versus expectations of $2.30 per share. Let me just run through the businesses that they have. The productivity and business processes came in at $17 billion. That's better than expected of $16.8 billion. Intelligent Cloud, that came in at $21.5 billion. That's versus the $21.4 billion that was expected, so a beat there. And then more personal computing, that obviously has taken a beating. $14.2 billion versus the $14.7 billion that was expected. CEO Satya Nadella said the next major wave of computing is born as Microsoft Cloud turns the world's most advanced AI models into new computing platforms. That clearly a reference to their multi-year, multi-billion-dollar investment in OpenAI, which is meant to help them better tackle competitors like Amazon and Google, not to mention enterprise services like Salesforce.
Yeah, ChatGPT could turn out to be one of the stories of the year as far as the economy goes. And we can see shares of Microsoft still up 5% on this latest earnings report. Dan Howley, thank you so much. Coming up, Microsoft trading higher. As you can see on those results, we'll get an analyst take and what's around the corner for Microsoft next.
Taking a look at shares of Microsoft, they're up just about 4% here in extended trading following their second quarter results. EPS coming in better than expected. Adjusted EPS $2.32. The estimate was for $2.30. Revenue, a slight miss there, but I think a lot of this excitement is about that intelligent cloud business. Revenue there coming in better than what the street was looking for. $21.51 billion. That's growth of about 18%, 24% in constant currency. Let's talk about this with Rishi Jaluria. He is the RBC Capital Markets software equity analyst joining us now. Rishi, it's great to see you here. So first, I know you've only had a couple of minutes here to dig through this report, but what's your first reaction?
Yeah, and thank you so much for having me. Look, I think this was better than people feared. I know there was a lot of negativity as I've been talking to investors about Azure slowdown, about cloud saturation, and that just hasn't happened, right? I mean, the Azure number on a constant currency basis actually came in a point ahead of guidance when I think people were expecting a miss. Office is looking a little bit more resilient than I think we expected, in spite of all the headlines we've seen about layoffs and hiring slowdowns. And so all in, I would say better than feared. And let's see how Satya and Amy guide on the call. But it's good to see an Azure number like this that isn't as bad as people were worrying.
The stock up about 5% after hours. Is that what you would expect?
Yeah, this feels like a little bit of a relief rally. Again, if you look at the action of the stock price heading into earnings, definitely felt like there was a decent amount of fear embedded in there. And I think Microsoft is, at least so far in the preliminary numbers, showing a level of resilience higher than people expected.
Rishi, when you take a look at AI, clearly it's a top priority. It's written in this earnings release. Satya Nadella being quoted as saying the next major wave of computing is being born. He went on to say we are committed to helping our customers use our platforms and tools to do more with less today and innovate for the future in this new era of AI. Clearly, they have a huge bet on AI. The recent multi-billion-dollar investment into ChatGPT, OpenAI. What do you make of that and the competitive advantage this could potentially give Microsoft in AI?
Yeah, absolutely. Look, I think the greatest thing that we've seen out of ChatGPT and OpenAI is really consumerizing and productizing artificial intelligence. And we look at OpenAI and Microsoft's investment there as being a call option on the stock. Honestly, it feels like there is a lot of room here, and I don't want to exaggerate. Artificial intelligence is the third big wave in technology in my lifetime, right? The first was the internet, the second was cloud computing, and now artificial intelligence is going to be the third one. And I see so much room throughout Microsoft's portfolio to integrate OpenAI and ChatGPT through everything from Bing search to GitHub Copilot to make it easier for developers to write code, to even integrating it in Office to make productivity a lot easier. Really the sky's the limit in terms of where they can, bring OpenAI technology throughout their portfolio. And I do think it will be a competitive advantage for their portfolio of products.
That echoes something Satya Nadella said earlier in terms of the magnitude of ChatGPT. One of the big stories other than that was, of course, the layoffs. 10,000 took a $1.2 billion charge. Do you expect more of that this year?
Not at Microsoft. I expect that at other software companies, but Microsoft has always been very, very profitable. And look, it's really unfortunate they did have to do RIFs. They did grow headcount by more than revenue over the past couple of years. But it feels like for Microsoft, this might be a one and done scenario unless the macro significantly gets worse. And what I think is really important with Microsoft's layoffs is they're still hiring in key areas. It's not we're cutting headcount and not hiring anymore. They're still hiring in Azure and security and a lot of other areas. And so it really feels to me like Microsoft will continue to hire, will continue to invest. And I don't expect another big round of layoffs.
Rishi, Microsoft was the first big tech name to report this earnings season. Clearly, we're seeing the street's reaction, very excited about this report. What do you think this signals, or does this signal anything about what we could hear in the coming weeks from some of the other big players there?
Yeah, I think it's signaling to me that a lot of other enterprise software companies may come up with a quarter that is better than people fear. In our own checks, we've heard that Q4, calendar year Q4 was better than expected for a lot of companies. Again, I think it comes down to the guidance, but if the guidance comes in, in line with expectations, I think that's enough. And so, given all the fears people had about tech and layoffs and everything, I do think this bodes well for a lot of other enterprise software companies.
How big a drag, Rishi, is gaming? And do you believe this Activision deal will ever close?
I do. I think, look, gaming it's a little weak right now, as we know, just with the delay of AAA titles and tough compares and all that. But ultimately, I think gaming is very strategic to Microsoft, especially if you think about Game Pass and the opportunity there to become the Netflix of gaming. And I think Activision is a critical part of that. I think Microsoft has played the antitrust game very well. I do think the deal still goes through, likely with guardrails around it. Something like all Activision titles cannot be Xbox exclusives for the next 10 years, not just Call of Duty, but any future titles get developed. And I think Microsoft is going to be willing to make those concessions because Activision is really important to that long-term vision on gaming.
And Rishi, earnings call about to get underway. What do you want to hear from Microsoft?
Yeah, I want to hear that, ultimately we're not at a saturation point of migration to the cloud, that there's still a lot of migration to the cloud left to be done, especially in traditional non-tech industries, that there's still a lot of runway for growth, and that Microsoft is very seriously thinking about ways to start productizing and monetizing this investment in OpenAI. That's what I'm really looking forward to on the call.
All right, an optimistic take there. Rishi Jaluria, RBC Capital Market Software Equity Analyst. Thank you, sir. Appreciate that. We're about 24 hours from Tesla's highly anticipated fourth quarter earnings release. Wedbush Securities' Dan Ives calling tomorrow's release and subsequent earnings call, quote, one of the most important moments in the history of Tesla and Musk himself. Now, we say that with the caveat, we love Dan, a little prone to hyperbole at times, but it certainly is important for Tesla. With their recent vehicle price cuts and year-end delivery numbers likely already priced into the stock, investors will be focused on how Tesla stacks up against expectations. The street looking for adjusted earnings per share of $1.12 with revenue of $24.1 billion. We'd love to hear more about margins, but we're certainly not. In terms of those price cuts, that's really a Q1, maybe even Q2 story down the road. But maybe we hear from Mr. Musk on the call.
Yeah, you got to think that an analyst or two are going to ask about that, the impact that it could potentially have on their business when you talk about some of that margin pressure from the price cuts. It also is going to be likely one of the first time CEO Elon Musk faced questions publicly since he abruptly left a Twitter Spaces with journalists in mid-December. Just last month, Morgan Stanley's Adam Jonas saying in a note to clients today that he expects management to be upbeat about the positive reaction following Tesla's recent price cuts. But Jonas adds that, quote, investors must have confidence that fiscal year earnings have bottomed before seriously revisiting the stock. That process for investors should extend beyond Tesla's March 1st investor day. This is all according to Jonas. So again, a number of things will be unpacked in this earnings report. A lot of it will have to do with the demand side of it. Some of that obviously will likely be maybe helped here with those price cuts. I think it's safe to say that management will likely be hyping up the demand that they have just seen in the last week or so after that. But I think stepping back, talking about the tough backdrop that Tesla is up against right now. Obviously, waning demand could have been one of the huge reasons for those price cuts, but also that stiffer competition out there. And we saw a number of other EV makers, a number of the traditional automakers that are in the EV space, their stocks under pressure following Tesla's price cut, because the thought there is that they might then have to lower prices and put more pressure on their margins as well. So again, I think just a broad takeaway in terms of how strong or how weak this sector is right now, and any trends that they could pull out, I think will certainly be a highlight in tomorrow's report.
Really just want to hear about demand into this weakening economy. I'd love to ask him, if you had a chance, how much time he is spending at Twitter versus Tesla. It's interesting because he has not been at SpaceX, and we've seen, well, the stock, literally the valuation, a rocket ship. We'd like to hear about the Tesla Semi. We'd like to hear about the Tesla Cybertruck. We expect him to be on the call. In the last call he was on, end of Q3, he said, looks like we'll have an epic end of year. I don't know how you define epic, but I think he was spot on about that in terms of the magnitude of the developments for Tesla, because they started with the price cuts in China, which were received very poorly. And then once they were really absorbed, they performed very well. Same thing here. We heard analysts very critical of those price cuts, but then it's popped demand at North American stores. And so it looks like a win-win there for him. It's going to be a very interesting report. Very fascinating call. One question for him?
Well, I was going to say, we also haven't even mentioned the Cybertruck. That might come up just in terms of the plans for there. The semi-truck, the additional plants that they have made. Did you mention the Cybertruck?
I mentioned the Cybertruck
you're talking so
and
much.
the
It's
semi.
hard.
I know, I'm talking too quickly. I apologize.
Well, I was going to say, there's just so much to dig into when it comes to this report in terms of the headlines that we could get out. A lot of it also has to do with some of those factories, too. Some of their new plants that they have made in Nevada, Mexico, Indonesia, any color there, I think will certainly be something that investors will want to know. And we will have full coverage of Tesla's reports minutes after the release right here on Yahoo Finance Live. Be sure to tune in to our live special here with Brad Smith, Brian Sazi after the earnings call tomorrow evening. You're not going to want to miss that. All right, well, coming up, generic perks. Amazon continuing to make big moves in the health space, now targeting prescription meds. Is the flat fee model the future for the industry? Find out how Prime members could benefit next.
Amazon is expanding its role in the healthcare space with a new subscription plan called RX Pass. Yahoo Finance health reporter Anjali Kamlani here with more on this. Anj, this is a very exciting opportunity. This is a space that needs a disruptor, and it looks like they're on it.
They are on it. They may be more of an interrupter if you listen to analysts on Wall Street. So let's break down what they've done. It's a $5 per month plan, but only for Prime members. So you already have to be paying for a Prime subscription in order to have this add-on. Then it's a flat fee for any generic prescriptions that are on the list, a very specific list that they already have, and that will be delivered either monthly or quarterly for free based on what your subscription is. Prescription, sorry. And also it excludes insulin, which is a key treatment that we know like a lot of people need. It's something the government has been focused on. So very interesting that that has been left out. But obviously it is a lot more complicated than just generics. Why? Because we know, also to point out the exclusions, no Medicare, no Medicaid. That's also a really important point. Now, we also know that generic space has been dominated by names like GoodRx. We got Cost Plus Drugs with Mark Cuban. We've got Walmart that really started the trend with the $4 generics, 17 years ago now. So this is not a new space per se. What they're doing is actually allowing people to do a flat rate, flat fee for whatever they need. But if you listen to my interview with the chief medical officer, you get a little bit more insight into what they're doing and who the target audience is. I spoke to him earlier today, Dr. Vin Gupta, and we talked about what this plan is and the specifics of who it's targeting. Take a listen.
I say this as a pulmonologist. I'm heartened by how patient-centric this program is. It's a $5 flat fee for any eligible medication that somebody may have a prescription for to treat one of many common chronic conditions that exist in the United States and worldwide. So chronic non-communicable diseases is really the focus of what RxPass we feel can provide a lot of value for and hopefully improve health outcomes and keep people healthy. But that $5 price point we feel is the right price point to provide value to our patients, to make sure that any eligible medications they may already be on that are prescribed for a condition like high blood pressure, high cholesterol, anxiety, male pattern baldness, broad range of conditions that are applicable here. That $5 price point for all eligible medications, so it's one flat fee as a Prime member benefit with included at-home delivery. We feel like this is the type of simplicity, affordability, and value that frankly has been lacking in the pharmacy experience that's existed for so many decades up to now, both from a provider standpoint and from a patient standpoint. We think this is needed change. The pharmacy experience that exists today, and as a lung physician, I interact with that all the time. It has not changed fundamentally in decades. Long wait times, it is not an easy experience to navigate as a patient, much less as a provider trying to do good for your patients. And so Amazon Pharmacy, to your point, it is, number one, it's staffed 24/7 with highly qualified clinical pharmacists that are supporting patients across the country. So clinical protocols are rigorously followed. We're making sure that prescriptions that are dispensed as part of RxPass or through our adjacent services are clinically relevant and indicated. So that's important to really emphasize here. It's 50 states, free delivery to your home. And really there's different ways based on an individual patient's ability to say have durable insurance or their unique situation. There's different ways to really intersect and pay for your medications. One is through insurance. The other is through your Prime prescription savings benefit. And then now today, RxPass, which we think will simplify how those who are on multiple medications for chronic conditions will experience care.
So as you can hear, a lot of discussion about who, what kind of diseases are targeted and the like, but there's also some interesting points there on who the target population is, what age groups, especially socioeconomic statuses because of that Prime subscription. But we also know that Prime is offered for at a discount for people who are on any kind of government assistance programs and the like. So there are windows there to help with equality of access. So I discussed the age group as well, and here is what he has to say about that.
We really do feel like for those individuals between the ages, and specifically between the ages of 40 and 64 years of age that might be underinsured, that this will provide and are on multiple medications for chronic diseases, that we think that this is going to provide disproportionate value for that specific group of patients. Having said that, if you're somebody that is, say, 30 years old and taking finasteride for male pattern baldness, you will accrue cost savings if you sign up for RxPass. Amazon, fundamentally, what I really admire about this company, especially as we explore what we can do in health and have impact, is we take risks and we embrace innovation. And we are trying to figure out the way in which we can maximize benefit to patients. And so from my standpoint, what exists today from a pharmacy experience standpoint is unacceptable. We can do better. And that's exactly what Amazon's trying to do here today with RxPass, is trying to do better for our patients and trying to provide disproportionate value by leaning into what Amazon has traditionally done so well, price transparency, convenience, affordability, and then lastly, selection, making sure that our formulary is as broadly pertinent to as many people as possible.
As you can hear, really a lot on the table there. Obviously, still need to see how it fits in with all the other verticals they have, the absorption of PillPack, the subscription model they have, and then the acquisition of One Medical also in the works.
That's a good look for Amazon in terms of just patient care and how they are caring about people. I know mental health is also a part of this in terms of Zoloft treating anxiety. I don't want to put you on the spot. How different is this than Mark Cuban's?
It is different because this is a flat rate. So this is, if you look at each of the drugs that are on the list, right? Okay. Half the cost of that is already in that $5. So you're basically getting a 50% discount, possibly per month, just by signing up for this.
Okay, I did put you on the spot with that, and you nailed it.
Well, listen, sometimes I like to know what I'm talking about, Dave.
You indeed do.
Never doubt her.
Great interview. Appreciate that information. Important story. Shauna?
All right, well, do you earn enough to be in the top 1% tax bracket of your state? A new study from Smart Asset ranking all 50 states from lowest to highest income needed to be in that top 1% of each state. Coming in at number one, your home state, Dave, Connecticut. You have to make around $955,000 to be in the top 1% of taxpayers there. Connecticut is followed by Massachusetts, New Jersey, my home state, New York, and California. In all of these states, you need to make over $800,000 a year to be considered in that top 1%.
My goodness, those are astounding numbers for ordinary Americans just watching this. $900,000. And when I look at that top five, there's really a fundamental disconnect that I see. It's really untethered from what you would assume, because my assumption would be that these would be highly performing economies. Not at all the case. I love my state. Connecticut is a wonderful place to live. However, at best, it's middle of the pack. U.S. News has it as the 22nd ranked economy in the United States. Now, California is the one that stands out to me. Massachusetts, a pretty solid economy. California, no, in the top 10. But New York and New Jersey is the 33rd overall ranked economy, according to U.S. News. And New York is 43rd. So again, really untethered to the success of that state's economy, shows how giant the wealth gap is in Connecticut, New York, and New Jersey, the tri-state area.
Yeah, certainly a massive wealth gap. And like you're saying, when you compare it to the average, what Americans are making, the average American household earns a median income of under $70,000. So $70,000 compared to over $900,000, the top 1% in your state. Obviously, a massive, massive gap there.
And Connecticut, I mentioned their economy losing Lego headquarters today to Massachusetts, one of those states on the list. Since most of us cannot relate to those numbers, let's look at the other end of the income bracket. And well, still pretty hard to relate to these numbers as well, but these are the bottom five, depending on how you look at it. The top 1% states, Kentucky, Arkansas, New Mexico, Mississippi, and West Virginia is number 1 or number 50, depending on how you look at it. But still, to be in the top 1% in West Virginia, $375,000 a year. Now, on the flip side of my observation with the top five, these are really tethered to, largely speaking, underperforming economies. West Virginia, Mississippi, Kentucky, and Arkansas, all in the bottom 10 of that U.S. News ranking of states' economies. Those are states that have been struggling, economically speaking, for a number of years. So that, on the bottom end, makes a little bit more sense. Still an extraordinary amount of money.
It certainly is. And less than 10% of all households earn more than $200,000, which is far below West Virginia there, which ranked 5th, which is just below $400,000. So I mean, clearly there is a massive disconnect, a massive wealth gap, like you were talking about when you compare really all 50 states. What we're seeing, the average numbers there, comparing that to the average household, the American household, what they take home every year. It's no surprise that so many Americans are being hurt so drastically by inflation, and with no relief really in sight. It's a very, very tough economy here for at least the next couple of quarters.
I'm sure there's some people in that top 1%, but that is depressing, seeing those numbers.
It's very depressing.
Knowing how far you are away from the top 1%.
Yeah, and you're up against the stiffest competition up there in Connecticut.
Man.
All right. Well, coming up next, Google CEO Sundar Pichai defending the tech giant's decision to lay off 12,000 employees. Stay tuned to see what he said at the town hall meeting next. Antitrust lawsuits are not the only headache that Google is dealing with this week. Following the tech giant's decision to lay off 12,000 employees, things got animated at a town hall meeting with CEO Sundar Pichai. Our own Ali Garfinkel is here to tell us more. And Ali, there's lots of unhappy Google employees right now.
There are, Shauna. I'd go so far to say that this didn't just get animated. It got to be pretty intense. This town hall really centered on employees demanding transparency for how these decisions were made. A lot of employees were laid off who weren't expecting it, who saw themselves or their laid off colleagues as high performers. And Sundar Pichai sat down and had a message for everyone. He said, nothing was random. What it actually revealed is he actually gave some insight into the process. But it appears that it was incredibly methodical. Even though this affected 12,000 employees, we know the process was exhaustive. At the town hall, he actually said that 750 senior leaders were involved in the decision-making process and that it took multiple weeks. That said, these layoffs have possibly been in talks behind the scenes for a long time. These layoffs, one expert told me, are some of the most predictable that we've seen so far in big tech. Look back to November, for instance. Activist investor TCI was calling on Google to start right-sizing even then. And what it called for was these kind of cuts. It was calling for aggressive action. And that is on top of the fact that Google famously pays some of the highest salaries in Silicon Valley. The median employee pay at Google/Alphabet in 2021, I believe, was $296,000 a year, which is more than Meta and a lot of its competitors. And Google's in a new moment, Alphabet's in a new moment. It's looking to compete for new AI-driven revenues. And this moment of we're going to get leaner has been coming. It was methodical, is what Pichai said. That said, what this town hall has showed us, if anything, is that Google still has some work to do when it comes to saving face with its employees.
It certainly does. Many are very upset right now. Ali Garfinkel, thanks so much for the latest there. Well, coming up, foul play. The FTC reportedly being pressured to investigate the soaring price of eggs, but hasn't. Lena Khan got her hands full with the like of Microsoft and Activision, Albertson and Kroger. Now eggs? We're going to get to that issue next.
All right, some breaking news now. Rupert Murdoch has withdrawn plans to recombine Fox Corp and News Corp. Discussions for the tie-up emerged in October last year with the special committee looking to bring the two companies back together. This after 21st Century Fox was spun off from News Corp almost 10 years ago.
All right, well, egg prices have skyrocketed over the past year, up nearly 60%. That's according to the latest inflation data. Now, this has one organization, Farm Action, calling on the FTC to investigate the egg industry. We want to bring in Joe Maxwell, Farm Action president, joining us now. Joe, it's great to have you here. We brought you on. There was a recent tweet that you just sent out saying egg prices were up 138%. You're calling BS on the excuses. Those excuses that you talk about are avian flu and inflation. You say it's price gouging. Why?
Well, first, avian flu is real, but the consumers know that in this country, something's wrong at the grocery store with a 138% increase in the price they're paying for eggs. It's obvious to us when we look at the profit that these companies are making, over 960% profit, that something's wrong, something's afoul.
Pun intended, I assume. 58 million birds killed from the avian flu. How significant, in your estimation, has that contributed to the rise in prices?
Well, it's obvious that the avian flu is real. 50 million laying hens lost. But from 2021 to 2022, that reflected a loss of production of eggs in this country by 5%. 5% is a number, it's a real number, but it does not justify a 138% increase at the grocery store, nor 960% increase in gross profits for the largest egg producer in this country, who has not experienced one case of avian flu.
Sometimes it's a blurry line between supply and demand and price gouging. How do you define that?
When we focused on the FTC Act, the Federal Trade Commission Act, there are several laws that govern this area. We felt that based upon high prices of eggs, moderating cost of production of eggs, and no one in the marketplace coming in to take over market share from the dominant firms, indicated something was going wrong. And we believe the FTC Act is the best place to talk about or have an investigation and review a tacit type of collusion. These companies working together to artificially keep the price high, using the avian flu and higher cost as a basis for getting away with this price gouging.
Well, Joe, in a statement, CalMaine did say that there were many factors besides the avian flu that did impact prices, such as fuel, labor. They go on to say, quote, the domestic egg market has always been intensely competitive and highly volatile, even under normal market circumstances, end quote. They also went on to add that they do not sell eggs directly to consumers or set the retail egg prices. So what is your response to that?
Absolutely. Well, according to their own filings in November, using a 26-week period prior to November 2022 and compared with November 26-week prior to November 2021, the company did experience a 40% increase in cost of goods. 22% of that was reflected in feed costs. Feed costs went up 22% year over year. However, again, their gross profit was 960%. They turned the company from a net income line item of a loss in 2021 to over $350 million profit. During the year, they're claiming avian flu and high cost was the basis for raising these prices. Their own evidence, CalMaine's own evidence found in the SEC filings would indicate something is not working right in the marketplace. And FTC, DOJ have authority to investigate and make that determination. And we're calling on them to do so on behalf of the consumers who are tired of facing these type of prices at the grocery store.
It is a staggering number, sir, and consumers are really struggling with it. What has been the FTC's reaction? I know Senator Jack Reed is also calling on the FTC to investigate price gouging. How have they reacted to you?
Well, in introducing this story, you indicated how busy the FTC is. We will also be looking at sending a letter to DOJ or copying DOJ in on that letter along with USDA. Under the Biden administration's whole government approach to antitrust and competition issues, we feel that we need to make sure every agency with this kind of power is alerted, and the ones that have the bandwidth should immediately take on this issue on behalf of America's consumers.
And what have been the focus here being on Cal-Maine? Have we seen similar types of price increases across the industry?
Absolutely. That's a key point. So matter of fact, Cal-Maine chose to raise their prices by themselves. You would expect Rose Acres or one of the other leading dominant firms would step in, take that market share away. USDA clearly reported in August that with a moderating feed cost and the high price of eggs, August of 2022, that the expectation of the market would be one firm would come in, put down more hens, have more eggs, and take market share away. In December of 2022, and this was our flag, in December of 2022, USDA ERS, that's the organization in government that makes these reports, indicated that had not happened. It had not materialized, was their words. So that begins to show that the market dynamics that one would expect in this scenario just aren't working, which would indicate perhaps some type of tacit collusion among the companies to keep egg prices high. I mean, why have more eggs if you're making more money selling fewer eggs? There's not an incentive, but yet the market dynamics say it should respond positively to add production and lower price. It's not working. So that's why we're calling on government to take a hard look, those agencies that have that responsibility.
Okay, Farm Action President Joe Maxwell, please keep us posted, sir. Thank you. All right, let's take a look at what's trending after hours with Shauna. All
right, Dave, we got a couple of names for you here. Microsoft, Capital One, Texas Instruments, and Fox. Let's kick it off with Microsoft. You're looking at gains of just about 4% here after hours. The company beating expectations when it comes to adjusted EPS, $2.32. The estimate was for $2.30. Revenue just a bit light there, $52.75 billion. Estimate was for $52.93 billion. But the cloud business growth there, that's what's really driving the stock here after hours. Intelligent Cloud revenue beating the street's expectation, $21.51 billion. That's growth of about 18%, growth of 24% in constant currency. Again, you're looking at the stock pop here, up about 4% after hours. And competitor Amazon, AWS, the cloud number there, boosting Amazon stock after hours. You're looking at Amazon's gains of just about 3%. Let's take a look at Capital One. That stock under pressure here following its earnings report, off just over 1.5%. Their fourth quarter EPS missed the street's expectations, coming in just about $1 below at $2.82. The estimate was for $3.79. Revenue, a slight beat there, just over $9 billion. Provisions for credit losses higher than what the street was looking for here, $2.42 billion. The estimate was for $1.85 billion, really indicative of the broader economic environment and the downturn maybe that we could potentially see here over the coming months. Car delinquency and also auto delinquency, both of those numbers growth up about over on a year-over-year basis. We're looking at losses of just about 1.5%. Taking a look at Texas Instruments, that stock now back in positive territory after hours, up just about 0.2%. Sales, though, dropping for the first time since 2020. They also offered a pretty tepid forecast. Some of their expectations there at the lower end of Wall Street's range. Taking a look at some of these numbers, revenue declining 3.4% year over year, but it was better than what the street was looking for. They reported $4.67 billion. The estimate was for $4.61 billion. EPS, $2.13. That was better than what the street was looking for. Gains of just about 0.2%. Also, keep a close eye on Fox and News Corp. We just brought you the news of Rupert Murdoch withdrawing his proposal here to explore a potential sale of these two businesses. You're seeing Fox up after hours, up just about 1.5%. News Corp under a bit of pressure here, off about the same as what Fox is up, off just about 1.5% here, Dave.
Okay, thank you, Shauna. Looking ahead to tomorrow, I'll be watching tech giant IBM, which reports fourth quarter earnings after Wednesday's close. Analysts are expecting adjusted earnings of $3.59 per share on revenue of $16.4 billion. We look into the conference call to find out what Big Blue has to say about a potential slowing in tech spending. IBM shares have shown some strength over the last year, up about 10%, with most of the gains coming in the last 6 months. Coming up, it can sometimes be a delicate balance. Where do you trim your budget and where do you spend? We'll tell you about the split brain budget next. You ever seen a Dollar General shopper with a Prada bag? It's not necessarily a fake they picked up on Fifth Ave here in New York City. It might, though, be part of a larger trend of Americans cutting back in order to afford the occasional luxury item. It's what the Wall Street Journal refers to as split brain budget. While the numbers reflect shoppers cutting back on everyday items because of inflation, a January Morning Consult poll shows 30% of Americans have purchased a luxury item in the past month.
I can relate to this. It makes you feel a little bit good, you know? It gives you some of that optimism, something that we all need right now. Dave, the poll also revealing that more than a third of that group spent over $100 on their purchase. When you take a look at some of these numbers, we talk about the fact that the luxury market has held up relatively well when you compare it to some of the other names within the consumer space. And taking a look at a lot of those estimates out there, Bain estimates that the luxury market's consumer base is going to expand by about 100 million between now and 2030. Right now, it's about 400 million. They're expecting that to get to 500 million by 2030. So more Gen Z, more millennials spending, splurging on those luxury goods. We're already seeing it happen clearly because people need that pick-me-up these days.
I hope you don't smack me with the Prada bag. Is this a female thing? Because I do not have split brain budget. I do not buy luxury items right now.
You spend some on
clothes. I do cut back. No.
No?
This is like 10
you have
years
nice
old.
Suits.
Well, yeah, that's because they go to the cleaners a lot. I mean, I don't purchase luxury items full stop.
No, you
right
gotta ask
now.
your wife when you get
I do cut back, largely speaking.
Yeah.
Trying to cut back on the Starbucks a little bit. So yes or no, you do think this is a male-female thing?
I think it's a male-female thing. Yeah, I just think that you're being smart. You're being frugal right now. Maybe I should take a page out of your book and cut back on my spending a little bit more.
You don't have a Prada bag to hit me with.
I don't. Not right now, at least. All right. Well, that'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you again tomorrow.